Good morning, Doug.
Hey, good morning.
It is a wonderful day to be alive. It's a unique day.
Yeah, the snowplow man was out here at Gimbal Financial. This guy's impressive. What is it? He's an attorney. He has a coffee business. I'm not sure what else he does, but pretty cool dude out there shoveling walks and making sure the driveway's clear.
Yeah, that's a big deal on a day like today.
-8. And the only other people I saw were the mailman, and Keith and I were talking about the mailman and male people and male ladies. And so the postal workers, the postal workers, I just admire their trucks that they were out there in this stuff. I mean, they're not four-wheel drive that I know of. They don't have chains on their tires, and they're out and getting after it. So I appreciated the postal workers this morning.
I added a warning today. Frostbite can happen in less than 30 minutes in sub-zero temperatures, and even faster than that when you have the fast kind of winds rocking and rolling and making noises like we're hearing at Gimbal Financial today. Well, I talked to a Northeastern friend today, and he said to me, "What's up with you guys from Indiana and your French toast?"
What do you mean? I don't follow it. What
He goes, you lose your mind when the storms come and all the milk, eggs, and bread is gone. So everybody, I assume, is making French toast. And
that's funny.
That's what. Yeah, hopefully you don't need any groceries out there, because it's a good day to stay in. I just came in to join Doug and you all and wish you guys just a Merry Christmas.
Well, if you need some French toast, let me know. I can drop some, or I can whip some up and drop them off to you on my way home. Yeah, this week, Keith, it's been a great week. I spent some time doing things I really enjoy, like being out in the yard before the snow came, just getting everything ready for the winter, and it gave me an opportunity to listen to like a couple months worth of IBD podcasts.
Nice.
And just had them on repeat. And so I listened to some recaps from earlier in the year. And
for those of you who don't know, William O'Neill back in probably 1984 founded a newspaper called the Investors Business Daily, and he was going head to head with the Wall Street Journal with his individual money. And I don't know that I think he lost money on it for decades and ended up selling it last year or so for some ridiculous number to the Wall Street Journal. But they switched it from the Investors Business Daily to the IBD because they started making it a weekly publication. Go ahead.
Do you know where he came up with the idea of the paper?
I thought it was just to serve his own needs. I thought he just wanted to hire people to do his research for him.
So he drafted the idea during a bear market. And so bear markets are great times to think and do things differently because not a lot is going on. And so this has been a really great year for Gimbal Financial. Gimbal has shifted. We've pivoted towards the future, and now we're pouring more resources into our own RIA. And one of the real wins for this year is just simple, but it's just been cash positions. And in cash positions, this is something that they were talking about on the Investors Business Daily podcast. Was number one, it is a position. It's not very exciting. We know historically it's not a great long-term solution. I mean, when you compare a cash position, and a cash position could be several different things. It could be your savings account at your bank. It could be your checking account. It could be a money market account, which is basically like a souped up savings account. Something like that is a cash position. We know it's not a great long-term solution, but when it hurts outside in the stock market, it's not a bad place to have a position. And so that's something I've been really thankful for this year. I'm thankful for all of you who've trusted us with that. And, we are actively watching for new ideas, but the cash position has been a strong one.
I was having lunch with a real savvy investor last Friday, and he reminded me, and I'm sure if you go back, if you happen to reread your anchors on a regular basis, if you go back just a few short months, there was an article about the German bonds selling at a negative 5% yield, that they were bringing them to the market, maybe as much as 10%, but and that was a lot of anxiety. Had somebody bought that 10-year, I think it was a 5 or 10-year bond, if they had bought that and these interest rates have done what they've done this year, they would have been in a world of hurt. And so I know a lot of the academic people say asset allocation works, but it's not quite that simple. It works during certain times. And so it's hard to know whether to be in bonds or cash, and depending on what kind of cycle you're in. And so when in a rising interest rate market, you sure don't want to be buying long-term bonds on the way up, because you're going to get smacked around.
We had an interview this year with a money market guru at Fidelity. And this guy, all he does is money markets, and he probably gets like one phone call a year, and this year it was from us. And so we got to talk with him just about the risk of money markets, what money markets are available out there to the retail investor and to the institutional investor, the institutional being like the Harvard Endowment Fund or something like that. But we talked about money market risk, we talked about opportunities, and just like you said, Keith, I mean, in a rising interest rate environment, it's hard to win anyway. And so sometimes the best solution is that simplest solution, to just have patience and stay on the sidelines.
Yeah, it's hard to do, but it's important.
That's not like recommendations and stuff like that. That's just, kind of what we're seeing. And if we were to get a rate cut someday, who knows when, that might change the way we look at things. But
well, that's a good lead into this. I'll
nice,
share my screen with you all. Let me see here. There's a button I can. There we go. I can make this a little bigger. All right, fans, hang on there. Here we go. This is historical data. This is not an opinion. It is the first time Fed cuts rates relative to the market bottom, and going back to 1969. So when you're having a bear market bottom, if we look at this first rate cut in the bear market of 1969, they cut the rates in August of 1969, and the market bottomed in May of 1970. That was a 9-month span. And so each of these show you the span between when the first rate cut happened and when the market happened. And I'm looking here, that happened at the same time in 1980. Same time in 1990, but if you took those two out, it's probably close to a year average in that, and we're not even to a rate cut yet. So
yeah,
I didn't put that up there to scare anybody or anything, but it shows why we're probably cautious today in the markets, because there's a good amount of uncertainty. So how many of you out there have taken out a billion second mortgage?
Okay. I think I know where you're going with this, but maybe I don't.
Yes, a billion second mortgage is a 30-year mortgage.
Okay.
So like I wonder if the mortgage guy said, now you're signing up for this for a billion seconds. Okay. Right. Just in case you're curious about that. So that's a 30-year mortgage. But if you wanted to know how many a million seconds what happened to be, a million seconds is 11.5 years.
Okay.
All right. You ready for the next one? 1 trillion seconds. So we go from 11.5 to 30, almost 32 years. 1 trillion seconds, 31,700 years.
Is that wild?
So if you gave away money that long, that's $1 trillion. So our government, the people you and I elected, just signed $1.7 trillion of spending. Another way I looked at that, I said there's supposedly 4.2 million people in New York City that are of working age. And I was saying, what if those 4.2 million people each made $100,000 and they worked full time to pay off this? It would take those people 4 years of their lives to pay it'd take 4 years for them to pay off that money. So 4.2 million people working 100,000 for 4 years. And if they just took all of the workers, and if we took all the workers in America, 156 million, and we each paid an extra $1,000 a year in taxes, we could do it in 11 years. However, it's going to be probably pushed on. There's two ways I think it'll happen. It'll be pushed on the backs of fewer taxpayers, or we're going to see more inflation. That's what I think. I don't know. What's your opinion?
Yeah, I think we're definitely going to see a combination of those two. And I really don't know what that looks like. I mean, I've never lived through anything like this. And so it'll be interesting. From everything that I've read and economists of the past is you just stop spending money. That's the answer. And so I think, what can I do? We could write our senators and our representatives, but what can I do? I can stop spending money too.
Yeah.
And I can help myself, my family be ready.
Yeah. And I would encourage you to communicate to your elected officials, because it's just irresponsible, in my opinion. And the amount of money that's being spent, it probably isn't going to hurt me. It's probably going to affect, Amanda and Eric and my children and maybe my grandchildren. And so to give you, I was trying to put this in another frame to help you understand the significance. It's estimated that the United States left $7 billion of equipment in Afghanistan last year.
Yeah.
$7 billion. And when you're spending 1.7 trillion, it's such a ludicrous thing to do that the $7 billion mistake they made, in my opinion, which I think is a reasonable opinion, is only 0.4% of that.
And if you were to break down that, like, how do you get to 7 billion? How do you get to 1.7 trillion? Like, when I broke down my spending habits, probably a decade or 15 years ago, I remember discovering that I spent $80 at Qdoba in 1 month. And I remember thinking, what in the world am I doing? I'm going out to lunch every day to Qdoba. Can I stop that? Yes. And so that's how you get there. It is, there's how many pages were in that spending?
4,000.
Yeah. And so there's like 4,000 like Qdoba, like pages of Qdoba expenses in there.
Yeah. You have to admit you have a problem, right? That's And so like, I couldn't believe when they left all that equipment there that somebody would do that the way they did, and that was a Qdoba expense.
And then go for some more.
Yeah, that was a Qdoba expense. So anyway, I'm done with that. I just thought I would throw that out there because I'm just puzzled. They did it in an irresponsible way right before Christmas, so it get hidden in the news of this cold storm that's going through. And so please don't be bashful in letting your representatives know. On the other side of that, I did see some good news this week, and we've talked about this in past shows. And this is from the U.S. Census Bureau. And in 2021, 5.4 million new business applications were filed. That's 23% higher than the 2020 record. And you can see all the way back to 2010 that they were averaging between the 2 and 3 million. That's a lot of new business people, and that normally happens through difficult times because people aren't finding work. They aren't finding work long enough, and eventually they go, I got to do something here. And so they begin to create some interesting business models and do things that are very proactive for the future.
If you've been following the stock market at all, you know that several of the big tech leaders that were once the darlings of Wall Street have really gone on a slide. And it's this new type of innovation that Keith's talking about with new business leaders. It's the new innovators that are going to carry this market to higher places. And we may not even know their names. Their names may not be household names yet, but they will be. And those will be the ones that can help us get out of this problem. Those are the ones that have traditionally led to new and higher markets.
And it could be an old name, but I'm checking something real quick while we're talking here. But like when I went to work for Texas Instruments in the 1980s, they I think had between 60 and 70,000 employees. Okay, which is just like that's a massive entity. It's difficult for them to be mobile and to do things. Oh, sorry about that. And now they have 31,000 employees. And so it's kind of like the Qdoba effect. A big company cannot be an innovative leader when it has that big a bureaucracy. So imagine our federal government when they're trying to lead the economy by borrowing that money. You can't spend your way into prosperity. You have to start cutting costs. And when you go from 70,000 to 31,000, that's a lot of families that are affected harshly. But probably Texas Instruments wouldn't be a business today had they not made those decisions. And so those kind of things are what set apart, I think, socialism from capitalism, is that somebody makes an adult decision to stop spending when you don't have the money. And it sounds harsh, but it's just the way that new opportunities come up.
And from a marketplace perspective, if a company like Texas Instruments or AT&T wants to make the internet faster, that hasn't changed.
Yeah.
But if they are cutting and laying off and their budgets aren't as big, they're not going to be able to grow through mergers. They're not going to be able to grow through buying another company out. And so some of these small to medium-sized companies, again, they're going to have to put it on the table, and they'll be the ones we'll be talking about by next year.
And who knows what that might look like. I mean, we talked about the artificial intelligence in the last couple of weeks, and how dramatically that changed the way that you and I maybe even look for some things on the internet. Right. It's kind of mind-boggling. If you guys haven't gone to openai.com and given it a whirl.
Was it Chat GPT? Is that what it is?
I just went to that website, but it might be the same
that's
thing.
The one I've been using.
Yeah,
it's a lot of fun.
Yeah, and it's kind of mind-boggling what it does, but that will change the way things work. I was watching a video. I could have put it on here for you guys, but you can probably go to YouTube and look for the first McDonald's, basically employee less. Have you seen that?
No.
Yeah, and it's kind of mind-boggling what it could look like. I'll call it fully automated here. I'm looking it up.
Oh, okay.
Yeah, first fully. It doesn't look anything like your current. Here it is. Here, I'll just put the picture on the screen for you.
People of TikTok.
Oh, I'm sorry. Here's what it looks like when you search for it. It's first automated. I looked on it YouTube, but if you happen to find this video here, look who's delivering the food in this picture. My guess is your French fries will be hot. Your burger, you'll have it your way, and it'll be the
you know what I like about that is just seeing that picture is there's the men and women behind the robot.
Yeah.
There's somebody who is in a robotics class at Fisher's High School right now.
Yeah.
Who is having a lot of fun designing stuff and blowing stuff up. And they're the people I see when I see that. I don't necessarily see the missing face. What I see is that kid who's really thinking right now. And that's just cool.
The whole process is just mind-boggling to me. And so it will affect a lot of this creativity is going to come from these downtimes. People are going to probably what'll happen is that they'll set up a bunch of these. This is my thought. They'll set up a bunch of these McDonald's stores, and the people will say, I kind of enjoyed seeing that teenager deliver me my food, and I don't really miss it being a little cold sometimes.
Yeah,
and
could be.
Yeah,
or you just go to a sit-down restaurant again.
Yeah, or maybe
the competition's there where that's
My Tuesday night hangout, they have a robot that delivers food, and it's annoying as all get out because it makes all these goofy noises. But that may or may not work either because they bring the robot by our table, and we're really tempted to grab a French fry or something as it goes by.
Hey, can we show that S&P chart real quick?
Yeah, we can.
So one of the questions around this time of year that people ask is, what's the market going to do next year? And there you go. And so that's exactly what I was going to ask you to draw. And so Keith just connected the tops of where we've been since January. If you look kind of, thank you. Yep, to the left, you'll see a top and then a sloping line down. And so one of the thoughts is, what will the market do next year? The answer is we have no idea. We have no idea what it'll do.
I thought you were a financial
the rest of this year.
I thought you were a financial advisor.
You know, and so the trend, there was a saying, the trend is your friend until it's not, but I think the trend is your friend, just always. And so the trend is your friend, and it's been trending down. And so this just tells us again to be more cautious. And there will be days where the prices are above the 200-day moving average, which kind of is, it's right along that red line that Keith drew. But when it's up above that, it's a little smoother sailing. So right now, I don't know, but it doesn't look great.
Our friend for which we've not met, I don't even know if we've talked to him, but I would call him our friend, Mark Minervini, just divides the market into two kind of markets, an easy dollar or a hard penny. And he's basically saying, would you rather work for a dollar and get it easily, or a penny and work hard for it? And when you have a market that's doing this, he just categorized it a hard penny market. And I know some of you might have a stock that has done well this year, but a bear market tends to pull down most stocks given enough time. And so that process of having a stock, being fortunate enough to have a stock during a bear market that holds up, is a real gift to those of you that might have something like that. But the majority of stocks have done well. A good number of the tech stocks, and I'll show you the NASDAQ while we're talking, but a good number of the tech stocks have done much worse than even this index. And here's the trend line on this one. This latest rally here didn't even make it up to the trend line, and it's well beneath that 200-day moving average. But if I were to pull up, and we're not recommending this, but like this was a darling stock a few months ago, Zoom Video, and this thing peaked out over here at $588 a share, and it's selling for $66 today. That is a difficult market, and there's a ton of these. Yeah, there was I got a pillow from these guys, Purple Innovation, one of our, I think several people I know swear by these pillows, but this thing was trading at $41 a share, it looks like. Yeah. And you can buy all you want today for $5 a share. And I wouldn't recommend that. I'm not recommending any of these stocks. I'm just showing you that there are tons of companies that have done much worse than these indices have. And so it suggests that this market has been rougher than what even you might even think that people have experienced.
Yeah, and we're optimistic people. We are believers in capitalism. We are believers in the innovators and the people making life efficiency. We're believers in America. We're just saying there's times, but you don't have to be a participant all the time. And the market that's, I think, been the most difficult is the 60-40 market. And what I mean by that is, if you have, let's say, a blend of stocks and a blend of bonds, and you've hoped that blend would see you through all types of different scenarios, they've both gone down this year. It's been absolutely brutal. And so please don't take this as us, being negative about the future or what we're seeing out there. We're coming into work every day excited about it, even when it's -8 degrees. But there's just times where it's best to stay next to the fireplace.
Yeah, and our opinion literally could change in a couple of weeks.
Yeah, I often say I'm bipolar on the stock market. Like just depending on what stocks are doing, we could change our mind like within half a day.
And the street's filling up with snowplow. Sorry.
Yeah.
And this is the volatility measure. It's the S&P 500. It doesn't measure the stocks. It measures the volatility of correlating stock options, but it just gives you an indication of how wild it is out there. This is when you have these kind of long lines like this, that's why I don't go to Disney. I don't like long lines, but when you have this kind of up and down thing going there, it's just going to be a hard penny market for you. And ironically, in the midst of this, if I were going to draw a couple lines, you could say it might be starting to settle down over here. And we'd like for it to settle down even below 20 down here if we could ideally get there. But it's not, here it was dropping off, and it just turned around, went right back up, and it just has been doing that all of 2022. It drops off and shoots back up. And so that's just a difficult time to get out and mess around.
Go back to the S&P real quick, if you would. So I mentioned those podcasts I was listening to earlier, and these podcasts I was listening to, they were all recorded in May. And so if we didn't know anything as of May 1st or whatever,
Okay.
or even there,
May 1st would be about right there.
The market was lower then, and it was kind of like their talk was, can it get lower? Yeah, it can. Could it go higher here? Yeah, it could. And that's the same place we are today, is we don't know. Yeah. But we can listen to the prices. We can listen to the shares being traded on the volume side. And that's really what we can do to control risk.
One of these days, right around here, I asked both you and Eric whether you thought the market would be higher or lower at the end of the year. I put it on my calendar. It showed up today.
I set up.
You did, and he said down. Yeah, and it's kind of it's been both, but at the end of the year, we still don't know whether it's going to be higher or lower.
I took a survey on AII this week. I take it every week, and I always say the same answer. I always say up.
Yeah, you'd like it to go up.
Well, I would, and I believe it will.
Well, and our friend Patrick, one of his sayings is the air is always better up above the 200-day moving average here. And I could plug in 1980. Let's just plug in 1986 and see what happened in 1986. See, like, look at this. Here's the 200. I didn't know this before I said it. Look at this thing went all this time, only dipped a couple of times right around it and bounced off of it. That's what a healthy market looks like. I can punch in 1995. I honestly don't remember what happened in 95. It was another above the 200-day mark.
Well, and if you type in 94.
Okay. There.
Yeah, because here there was some inflation type pressures that were happening.
Yeah.
And so this is a similar type thing where we came up to the 200 in June and then back down. And then once it breaks through, then that's a different ball game. But that's just, I think, a really good market to go back and look at.
Yeah, and I was just picking off the top of my head. I'll go one more off the top of my head. In 2005, here we go. It stayed mostly that year above the 200-day moving average. So
and that's after a rough 01 to 03.
Yeah.
Yeah.
Yeah. So those are definitely interesting things to pay attention to. I don't know about you, but I think I left a voicemail for somebody earlier today. Just breathe in the moment. Just like if you're out in the woods and you had pine trees around and you could just absorb that experience. But that's what I would say with your family these next few days. Like, I know, after 3 or 4 days, they kind of become like fish, they could get a little rough in there. But like, if you've got family coming in and just being patient, showing kindness, and just breathe in the experience with them. And I think what I've observed, the best way to do that is have some thoughtful questions ready to ask people. I found a picture of my brother this week, and it was a school picture, and he was at a different grade school than me. And I thought I never knew he went to a different grade school than me. And when I gave it to him, he said, no, my mom must have been teaching at that grade school. And cool. She got him one of the pictures while he was there. But any thoughts you have for families as they're going into this next few days?
No, I just say Merry Christmas to you guys. I want to thank you for being part of the Gimbal family. I was looking at our Christmas cards that you guys have sent in, and I really appreciate all those. And so it's been a really great year to grow with you. So thank you for that.
Thank you very much. Are we going to be here next week, Doug? What are your thoughts?
I think so. Unless you want to.
I'm trying to pull up and see what that day is.
I mean, I think that's the 30th.
Is the market open?
Market's open. Yeah. And
We'll
so-
send you an email if
Yeah,
they
we'll
change
see.
your mind. Yeah, if you get an email, we'll be here. If you don't, then we'll see you guys in 2023. And God bless. Merry Christmas.